Hello, everyone. It's Tim Davis here, and I'm coming to you guys with my weekend market review. Today is Saturday, May the 21st, 2022. The time now is about 11 a.m. Eastern Standard Time. I want to start out this weekend by looking at the overall breadth of the market. I'm going to look at it by taking a look at two different tools that I like to use. If you use Thinkorswim, if you're looking at my screen now, this very first one that I like to use is the tool that shows the percentage of S&P 500 companies that are still trading above their 200-day moving average, just to give you guys a sense of the overall breadth of the market. The higher the number, the better it is for the bulls, or the in the direction of this percentage, the better it is for the bulls. So lets you know that the top of this echelon means we're normally doing pretty good as far as the a bullish outcome, and as we drift towards the bottom of this echelon, it means the breadth of the market is leaning more bearish. So with that said, this is a monthly chart of this tool, and I highlight at the top here is where we normally see reversals in the overall market. The highest we can get to is obviously 100% of the S&P 500 companies trading above their 200-day moving average. Only problem with that is that as you approach that 100% tile level, normally you're looking for some type of serious reversal to start to happen within the market. And this is a monthly chart dating back way back to 2005, but I'm gonna focus on 2009 to now. The highest that we've gotten as far as a percentage of stocks trading above their 200-day moving average within the S&P was 97%. That was hit in May, around May of 2021, around April of 2021. And that was the highest level reading that we have had as far back as I can see as far as history. Previous times we have gotten to as high as like in 2009 we got up to as high as 97. Then you see what happened after that. 2009 we got to as high as 97. And other times we were in between 92 to 95. So I'll highlight this area too as well, because this is when we started to see a reversal back in 2000, between the 2007, 2009 time frame. Actually, 2000. Let me even date this back to here, about February 2007 is when overall market started to see some downward motion. So from 2007 down to 2008, we got a little bounce in 2008, only back up to the 20-period moving average. Then we got another decline, another little bounce around May, around that time frame. And then from May until the end of 2008, we finished much lower. And then we pretty much hovered around these lows for several months until the market decided to reverse around sometime during the March of 2020. I'm sorry, March of 2009. March 2009, market found a way to reverse. So anytime we are up around these highs, around 92 to 95, 97%, normally we see a reverse in the overall market. Hence now, 2021, we were trading as high as 97% of S&P 500 companies above the 200-day moving average, and we all know what happened since then. In 2020, right around the COVID plunge, we were trading up to about 88%. And then we had the COVID plunge scare and we dropped like a rock. And then we had a quick snapback. I like to point out that quick snapback because the markets, pretty much to me, that was a signal that there's something, worse is coming after that, got that quick snapback. Quick snapback all the way up to this level around 90 to 95 when we hovered around that level for most of 2020. Then into 2021, and then right around May of 2021, we started to see a slow decline in the breadth of the market. So now, where are we now? Look at this, only 24%, folks. So that's roughly saying 75% of the S&P 500 companies are below their 200-day moving average. That is a straight up bear. That's no other way to put it. This is a bearish environment, and it doesn't like it's ready to get any better anytime soon. And also, you can look at my moving averages here. We got my 20-percent moving average, which this yellow line is now crossing below the 50-day moving average, which is the blue line. So the breadth of the market, as we can see, is strictly negative, and that does not look like it's ready to turn around anytime soon. My ultimate target, I think we're heading for, is back to the same area that we've seen in 2020, and maybe even much lower than that. I'm thinking even maybe as low as what we've seen in 2009, back down to 0%. That's why you see me got this arrow joint. I think that's where we possibly could be going. All right. And that's almost a 0%. Yep. Get down to that level, be 0% of S&P 500 companies above that 200-day moving average. Now, one more way to take a look at the breadth of the market. Again, I share this every week. Again, this is pinned to the front of my Twitter feed. If you click on this link, it'll take you to the wallstreetjournal.com tool that's showing the new 52-week highs versus the new 52-week lows. You can run this scan multiple times a day, and it just tells you how the day is going. I like to take a look at it in the morning, sometimes in the afternoon, and definitely after the market closes. So this shows you the last reading on May the 20th, 2022 at 4:15 p.m. And if you look to the left of the screen, you see it has a tab for the New York Stock Exchange, and it has a tab for the Nasdaq. So let's click on the tab for the New York Stock Exchange first. And right at the top, you always see the new 52-week highs. So this tells you that the New York Stock Exchange created 15 new 52-week highs. And let's scroll halfway down. We'll see how many new lows were created. 365 new lows were created, folks. That is still telling you that the overall breadth of the market is strictly negative and bearish. You have a lot more. That's a lot more, almost. That's a big difference from 15 to 65. 15 and 365. That's a big difference. So we got many more new lows being created than new highs. That is a strict indication that the overall sentiment of the market is a bearish one. Here is the Nasdaq, which shows 16 new 52-week highs that were created. Scroll halfway down, 483 new 52-week lows. So the market is still creating new 52-week lows until this starts to dwindle. Okay, folks, you need to be very mindful, be very careful about holding these long positions. Now, we have some rally days where the market is just, having these bear market rallies. And I guarantee if you was to come to this tool, you can see whether or not it's something that could be sustainable, because then you'll start to see this flip-flop. Start to see more new 52-week highs and new 52-week lows, or you'll start to see the new 52-week lows start to dwindle a lot more than what it is now. So just keep that in mind. Have those big rally days. Glance at this tool and see if we are starting to see light at the end of the tunnel. All right. Now let's take a look at the overall indices. We'll start out by taking a look at the VIX. Let's go straight to the VIX first. All right, here is a look at our VIX, and we're going to take a look at the daily chart of the VIX. I want to point something out here on our VIX daily chart before we glance at anything else. Here's a daily chart of the VIX. And what I want to highlight is this range that the VIX has been in. We've been range bound in the VIX for the past since April. So we've been stuck in this range right here. And if you look at the left side of my screen, we also were in this range before. This sort of looks like almost an inverse head and shoulders. So this leads me to believe that the VIX is probably on the verge of breaking up out of this upper range. So this upper range It's what I'm really, this upper, trend line is what I'm really focusing on. When the VIX finally breaks above that level, folks, I'm telling you, it is going to be a seller's market in a big way as far as the overall market. So now this pattern that formed on the VIX on last week, we could see the VIX go lower sometime this week. But I really think that it's going to find support right around this $26 to $27 level. So do expect the VIX to possibly pull back a little bit more here and then get a bounce in here somewhere, maybe towards the end of the week or sometime next week. It's not sure when or how that will pan out, but we could see the VIX pull back and possibly see a bounce throughout the week. Let's see how that pans out. But this is the range that I think the VIX is going to remain in until it finds a way to break above that $40 level. And here's a weekly chart of the VIX. I like to point this out because, as you can see, we can look back over the past year. VIX has been really getting close to tagging this resistance level, and it's been tight within that range that I showed you. In this area here, we've been tight. Dipped below this level a little while ago and came right back above it. So it seems like a possible inverse head and shoulders here forming on this VIX weekly chart. So looks like we keep tagging this support level and been getting a bounce. Every time we hit around that 27 level, the VIX finds a way to get a bounce. So looking for a big, strong bounce. And I think it's going to happen eventually when the VIX just breaks out above that $40 level. All right, let's go straight to the S&P. All right, here's our S&P 500. I want to work backwards. I want to take a look at the monthly charts first, folks. I really need to stress this, how prolonged this move down could be if the VIX, if the overall market doesn't find any footing. So this is a longer term monthly chart of the S&P, and I marked some areas already here where I see that were previous levels of resistance or support. And notice how we've been in this long move up since 2009. Nice stretch move up, and then look at what's starting to happen now. And then you can see in the monthly charts, it's like a quick reversal and a rollover effect. Starting around the beginning of the year, the S&P. So right around February or March, we started to sort of roll over. We started seeing a breakdown in this overall bull market. We came back down to a trend to a level of resistance. I'm sorry, support level. Tried to fight that off beginning part of the year, and it's like the bulls just could not hold it. And we finally broke below that level this month that we're in now. So that now becomes a level of resistance. So this level here is going to be a level of resistance. So we're going to see how markets react to this. So let's see if we close above this level by the end of this month, or if we close below this level. So that's a monthly chart. So it's still, that candle's still working itself out. And I'm going to go to a daily chart. So on Friday, those folks who were paying attention on Friday, there was a big down move in the market sometime during the day, and then towards the end of the day, markets rallied back hard. So we see this short body, long wick on the bottom, sort of like a hammer pattern. Markets bounce back quickly. So what we could possibly see, we are in oversold territory on the S&P in the short term. So, but I would not be surprised to see a continuation up somewhere around here, or maybe even tag this level of resistance. So that's a huge possibility. But as we go up, again, pay attention to the overall breadth of the market. If we go up and it's not a lot of volume supporting that, or the volume starts to dissipate on this daily chart, we get close to that area, folks. If the market decides to go up that high, we're probably going to see another lower low created. That's what I'm expecting to happen. Probably see a little move up and then all of a sudden another lower low. It's possibility, folks, we can see the S&P drop below 3,700. I mean, below 3,800, hitting around the 3,700 series somewhere. Oops, let me do that. Let me do this. So keep an eye on that. Markets made a quick snapback towards the end of the day on Friday, so we could see a continuation of that. But any of these, if we do have another bear market rally, it'll probably be short-lived. And I'm going to even go as far out on the limb as doing this. No, I'm going to do this. Let me get rid of this. So this little snapback we had here, we could possibly do something like this. And possibly get the same type of move, same size, same magnitude. So we could see the, a nice little move up in the S&P sometime next week. So there's a possibility. These moves seem to we have these, and that's how the market normally goes when you have a downward cycle or upward cycle, especially downward cycle. It's like a stair-step move down. So we see this move here down, then we got to move up, we got to move here down. And we could be seeing a little some further upside, and then it could be all over again. So that's something to pay close attention to. So that's a breakdown of the S&P. All right, let's take a look at the Russell. Let's take a look at Russell while you're at it. So the Russell, again, sort of looks just like the S&P. We got the full stochastics or wins percentage oscillator starting to turn up just a little. So again, there's that resistance right over here. So we could see another snapback rally with this reversal towards the end of the day on Friday. So we could see a quick snapback rally, but look at this tight range. Look at this tight range. That's just below this level of resistance. So we could see it move back up to the level of resistance. Then we could see it just another move straight down. We have to see how that pans out. But I think any moves to the upside is probably going to be muted and probably going to be, stopped short due to a lot of overhead resistance. That is a Russell. And let's go straight to our Nasdaq. Same thing. So Nasdaq daily chart, again, we had a big down day throughout the day, then a big rally towards the end. And again, we could see some continuation to the upside, maybe up to that level of resistance. I said it pans out, and then maybe a sharp reversal. And as it relates to, and even looking at the, if you look at this frame where I have my moving averages in here, this yellow line is my 20-day moving average. It's almost on every index. 20 has been acting as a strong level of resistance. So every time we drop so much, we get a rally back up to the 20-day and then drop again. Right here, we almost made the 20-day, but we pulled back slightly short. And the Nasdaq, I think, is probably going to even have the most trouble, because I think this Nasdaq is really reacting to this 20-day. And as price action starts to go up, if we go up to this moving average, will start to come down. So we can probably hit that moving average real quick and this reverse in a big way. So pay close attention to that on next week. Now let's take a look at the Dow. All right, our Dow Jones, same scenario. Again, overhead resistance. And for the Dow Jones, and if you notice for the Dow Jones and for the Nasdaq, I had Fibonacci retracement that I drew when the market started falling, and this fib has been acting pretty well, and it's been giving me some good levels to pay attention to. It looks like if we do get a rally, we could rally right back up to the 23.6% Fibonacci retracement on the Dow. Then again, there goes that 20-day moving average is coming traveling right along with price. So as price rallies and falls, this 20-day has been traveling right along with price. So I suspect this 20-day to continue to trend downward. As price rallies, it probably hit that level and then come right back down. All right, so that is our S&P, our Dow Jones, our Nasdaq, and our Russell. Now let's take a look at two more that I want to focus on. One is crude oil, folks, because crude oil is like it's still stuck in this range. I'm telling you, if crude oil gets this bounce out of this range, and a sustainable bounce, because we got out of that range once on last week, got out of that range, then quickly dropped right back into that range with a doji too on this daily chart. Got out of that range, came right back down into that range, but look what it did. It got held up. It got caught by the 20-day moving average. That tells me that this price actually really wants to break out of this in a significant way. So that will be a not a good sign for it's definitely not going to be a good sign for gas. If you guys think you were paying high gas prices now, wait till we get halfway through the summer, folks. I don't think we've seen nothing yet with these gas prices. If oil finds a way to break out of this range and start to see a sustainable move to the upside, expect the gas prices to start to really soar. So I hate to be a bearer of bad news, but this summer is going to be a rough summer as far as gas prices, folks. And on this chart, you can see this range even that much clearer. Look at that range that the crude oil has been in. It's like it really wants to bounce and stay out of this range. So one way for those traders, what I'm saying, to take advantage of these high gas prices is put some market money in your pocket, trade some of these oil stocks or USO directly. And as prices go up, I'm saying, at least you can get some increase in your portfolio by trading some of these oil companies, especially the USO itself, which is the ETF for crude oil in the United States. So that's crude oil. One more I want to kind of take a look at again. Gold is kind of hard to predict right now because of just where it's been trading, but also it too has been still trading within my long-term range that I've been tracking for quite a while. So let's take a look at this long-term range. Looks like gold is in this long-term range I've been tracking for a while, and it's like it's ready for a bounce again. So here is a weekly chart. So gold has been on this upward trend on this weekly chart for quite a bit, and every time we have tagged the bottom of this trend line, we have seen a bounce. So I'm thinking that we may be in store for another bounce right now for gold. Looks like we are back down to that trend line, dipped below it just a bit. It looks like this is a weekly chart too. Looks like the oscillators are starting to turn up on the wins percentage and on the RSI, starting to curl up. The stochastic is starting to curl up, and we got a little green candle here, which formed on last week. So next week could be the beginning of another attempt for gold to run back up to this upper trend line. So get your gold stocks tuned up, get your oil stocks tuned up, and prepare yourself, because we could be in store for the next move back up towards the top of the range. I want to say the top of the range. I don't know how it's going to act when it gets there, but I think we're going to see a move back up towards the top of the range. All right, folks, that is all I have for you guys this weekend. Remember, don't let nobody fool you. We're in a bear market, and inflation is out of control. As long as inflation stays out of control, as long as we still have supply chain issues, as long as we still have, COVID issues and breaks out across the world, where a lot of countries are shutting down plants and things of that nature. And as long as we still have this war in Ukraine, and then folks, do not sleep on what's going on over in China, between China and Taiwan. I think China is sitting back, seeing how this Ukraine-Russia thing plays out. And the U.S. has been very, very close with Taiwan, not wanting China to come in and just try to do the same thing that Russia's doing to Ukraine, trying to, make them become a part of China, instead of having an independence. So China's been watching that play out over in Ukraine. Over in Ukraine and Russia very closely. and start paying attention to what's going on over in China, and where the U.S. have a lot of their naval ships positioned over there. So don't sleep on that. If for some reason something sparks up between Taiwan and China, folks, the market is not going to take it well, and all bets are off at that point as to what happens. So, all right, folks, hopefully this is some information you can use. Until next week, I will catch you guys on my next video. And like I said, throughout the week, folks, I've been posting some quick nuggets. Anytime I see a crazy shift within a market or a sudden shift, I've been trying to keep you guys updated as well. All right, take care, folks. I'll see you on the next video.